Google stock has just hit a new all-time high after a court ruling. Now, CNBC believes the stock can go even higher, but not everyone agrees. So let's take a quick look at that.
All-time high it would be if we were in regular trade. Guy, what do you think?
Can't do the counterfactual, but I will attempt. I mean, you can make an argument. Tim and Karen have said this, that if they had broken up Google, the stock would have probably gone higher. So maybe it's the certainty of some sort of outcome that's getting this relief rally. So you want to play stock market. 214, I think, was a prior high. Maybe it back and fills back to that level, but it deserves at least a market multiple, Google. So you throw $11 a market multiple. This is a stock that should be trading between 240 and 250. Then if you want to give it a premium multiple, you can see where it goes. But I think this allows it to sort of get that valuation that it deserves.
You know, it's funny. I'm hard-pressed to see, like, how much better it gets from here. You know, they have, 90% of search queries. Okay, they already have that. It was never going to get better than that. They have 70% of, search ad revenue, right? You can see how this company is deemed to be a monopoly. That was the ruling. Now we're at the remedy part. I think Jonathan kind of laid that out. And so when I think about this business and I think about how many platforms this company has, over 1 billion users, I mean, think about, they have, between 1.5 billion iOS users that they basically have a lock on that search, at least on those iPhone devices. They also have 3 billion on Android, which they own. So think about that. They have half the population of this planet already on devices that they control search for. So when you look at the stock opening up like this or trading up where it is right now, you have to say to yourself, how is this going to meaningfully add to their earnings? Now, you're going to say to me, Karen, well, it trades at 20 times, next year, expected earnings growth of, let's say, 7 or 8%. I say to myself, I mean, I'm not this is amazing for them. There was so many worst case scenarios that could have happened. But I think 8-10% on the stock seems kind of odd to me.
So the decision has finally now been made, and the shares were up around 8% after we heard this yesterday, and ultimately they are avoiding some of the worst case penalties that many investors were a bit worried about. It is now sitting up 6% in the pre-market. Will be interesting to see where this goes upon market opening, but ultimately they get to keep Chrome. This was one of the major worries investors had, so a lot of good news, and hence why the shares are in fact climbing. In fact, it was noted here some of the worst case penalties were being floated about, but that is not anything investors now need to worry. We do also need to consider what actually is in place. What are some of the things that we now need to consider, whether we want to buy the company, whether we want to hold or in fact sell. But Google have to ultimately hand over some of their search data to their rivals. Not a good sign, but ultimately the key thing here for shareholders is that they didn't enforce any of the larger changes, as we just heard some of the worst penalties that they could have had in play. Now, Google did release a statement, and pretty much the most important bit is that they've imposed how they distribute some of their services, and ultimately they have to share their search data with rivals. But really, one of the largest takeaways here is that they don't need to divest Chrome as well as Android, and running this through ChatGPT, we get 5 key points. The first one is that a monopoly is confirmed, but there will be no breakup. In fact, the judge did confirm that Google has unlawfully maintained a monopoly in their internet search. However, there was no consideration for the breakup. As he said, this is too drastic and there's no evidence to essentially support that this is the right move. Now, a few of the key points that actually affect the company: they're banned now from making any agreements that allows them to become the default search engine, and that also includes some of their own related apps like Gemini, and they're also unable to lock partners that they have already into any multi-year commitments. So we can really see the judge is trying to stop them from continuing to be a monopoly, which he's already said is what they are, and that they also have to share some of their search, some of their data with rivals. Not great, but again, it is one of the best case scenarios out of all of the other options that were in play. But one thing that's been allowed is that they can still pay very significant amount that we'll come on to be the default on Apple on the iPhones. And this, the judge points to reducing consumer benefits and innovation if they were to stop this continuing year on year. And actually, because we're seeing a lot of generative AI, whether that's ChatGPT, whether that's Grok as well as Gemini, that actually shaped the conclusion in his decision, hence why we note here doing those overly aggressive remedies such as the breakup. Now remember, yesterday we started the first day of trading in September, which due to seasonality is the worst performing month in the S&P. Clearly we can see the market got that memo. There was a lot of red right across the board. But Google, nice to see a 6% increase in the pre-market. It was as high as 8%. Who knows where we will sit at the end of the day. But one thing's for certain, it will open today at a new all-time high. Now it's up around 34% in the last year. Year to date, up around 12%. And over the last 10, it continues to significantly outperform the S&P. And whilst we will cover the valuation shortly, before this announcement, both Seeking Alpha and Wall Street had this at a buy. Wall Street 4.46, very near 4.5 to flip them into a strong buy rating. So we do believe over the coming days, a lot of analysts will start revising their price target upwards. As we heard at the beginning of the episode, the CNBC analyst believing that this at a bare minimum should be around 240, 250. But what this means is the forward P prior to the announcement was sitting in line with the 5-year average. We will see this creep up now to around 22, 23, meaning it is slightly above a reasonable signal, not overvalued just yet, but definitely something to consider. And that's also what we note when we look at the blue tunnel. Remember the parameters within here highlighting the intrinsic price. It is sitting right now in the middle, but factor in the parameters here, the upper and lower end, 194 to 237. It isn't sitting at an overvalued space just yet. That would be around the $240 mark. One thing that's also interesting to note is that over the last 5 years, this company, for whatever reason, continues to be mispriced by the market, severely undervalued. That is where we get disparity between the trading price and the bottom end of the blue tunnel. As always, make sure you are subscribed, notification bell is on. When we see high quality companies that are severely undervalued, we will let you know. But also when we incorporate growth into this company on a PG ratio, we're looking at 1.35. Now yes, it is below the sector, so you are getting a 9% discount, but interestingly it sits around their 5-year average, which yes, we would say reasonable signal, but ultimately when we get a PG below 1, that is when we say massive opportunity. When it's below 2, that is what we would say for consideration. So even with the increase, as we'll get onto in the DCF model, it still could perhaps look like one for consideration. And as we mentioned earlier, the ruling also covered the way that Google pay Apple quite a significant amount every single year. We're talking $20 billion in revenue for Apple to allow them to be the default search engine. And we can see here Google is permitted to pay browser developers like Apple, and that cutting off payments from Google almost certainly will impose substantial, in some cases, crippling downstream harms to distribution partners, related markets and consumers, which counsels against a broad payment ban. Now, if we saw that, maybe the share price would have gone in the other way, but it isn't something that's just positive for Google. We can also note that Apple got some nice upside to the stock. In fact, it is sitting around 4% in the pre-market, whilst even at that price, it isn't near their 52-week high. Definitely a positive sign for shareholders. But also remember, Google is a very strong company, and this just further highlights that they're a company that reports on their bottom line the most out of the Mag 7, and in particular, in comparison to Microsoft and Apple, we're talking $111 billion. That is a significant amount, and their earnings also go on to prove that. Their most recent quarter, top line was up 14% year on year. Search advertising, where some analysts believe is dying, up 12%, and one that maybe is coming into the spotlight a little bit more is Google Cloud, up 32% year on year, which we can see continues to climb in the double digit. Just the most recent quarter, as we said, 32%, but that isn't the first time we're seeing these very strong numbers. And in fact, it's also growing faster than AWS that sits a lot lower at 17. Microsoft, in fact, the fastest growing, at least in this quarter, up 39%. But they do have a very large backlog, which continues to increase a whopping 51% year on year. And whilst they may not be number one in this space, sitting at 13% market share, that does just highlight they have a lot of scope for growth at least in this area where they're continuing to climb. In fact, the market as a whole is up 25% year on year, so they're actually growing faster than the market, highlighting they are taking some market share away from AWS and in fact Microsoft. But it's not just that, we also see the YouTube element that always gets left behind. When we go back to 2023, Netflix held 7% of the US consumer TV time, YouTube 8%, and whilst Netflix has increased very minimal to 8%, YouTube continues to power higher and higher. We're talking 13% today, which is also reflective in their ad revenue growth. Yes, Netflix continues to be a little bit higher, but just look at the comparatives in terms of the compounded annual growth rate. Google at 18%, Netflix at 13%. It may not be that many quarters before we see the complete reversal. And it's also one that institutions clearly love. They've got 40% ownership. Yes, they sold around 60 billion in the last year, but in the same time frame, they bought twice as much more. They bought 3 times as much more in the most recent quarter, 40 billion versus 13 billion selling. And if you wanted the reversal where they sold a lot more than they bought, you'd have to go Q2 2023, really highlighting institutions' net buyers considerably bullish quarter after quarter. But it isn't just the institutions. In the most recent data from super investors, it was the 3rd most bought stock. In fact, it was joint second with Amazon, where 12 individual super investors continue to add to their position. And actually, it looks to be the 2nd most held stock, with 33 investors holding this in their portfolio. But we also note the other ticker symbol here at 28. Remember, the difference between the two is purely just the voting shares. And stepping away from this decision, it is ultimately a high quality company. Their free cash flow per share continues to climb over the last 10 years and expected over the next 12 months, which as always, that is what we want to see, consistency in growth, and that applies to their top line revenue. Out of the last 10 years, 9 of them have been double digit, including the most recent 2024. In terms of a numerical perspective, while growth continues to be what we're seeing, more than quadrupling it in the last 10 years, and yes, doesn't pay the largest dividend, but one way they return excess cash to investor pockets is through share buybacks. That is what we have seen over the last 10 years, and they are starting to ramp it up. We do note share buyback programs and ROIC, very important, whether it's Google or any other companies. You want a minimum of 10% to give you faith management are able to effectively allocate their capital. Not only that, but it continues to climb, sitting at 26% for the full year in 2024. And let's not forget the margins. As always, high quality companies, not only are they going to be hitting the minimums, but they're going to be increasing over the longer term. That is literally a criteria for a high quality one. 26 10 years ago, now sitting at 33, where their free cash flow margin fairly consistent, sitting at 18% on a trailing 12-month basis. Now finally, we get to one of our favorite metrics alongside the ROIC, net debt to EBITDA, highlighting the number of years it would take them to pay off all of their debt net of cash on hand. We can see 0 across the board. We want a maximum of 3. This highlights for Google and correlates to balance sheet strength. It won't even take them 1 day to pay off all of their debt net of cash on hand. Now, before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We draw one every single Monday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market in the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our intrinsic value gets to $229. Using the DCF model, we have average growth of 20%. We've got 12% moving forwards, although you can see low, medium and high, 10, 12, 14 respectively. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's Google or any others. But using 12% with a discount rate, it gives us the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, coming to 229. Now that does only indicate 3% upside, and if you want to be conservative using 10%, we get to 199, indicating downside of 11. You want to be a lot more optimistic at 14,263, indicating 18% upside. Now we will also flag using a reverse DCF already priced in is 11.6% growth year on year. Just something to bear in mind. If you believe that's too high, then already you see this as overvalued. If you believe actually that is on the lower end, then maybe possible undervaluation. Using the 12% though, this does give us a margin of safety, but only 3%. Typically on the channel, we want to see 10% at a bare minimum. We'd execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, making it a buy at $206. If you wanted 20%, a buy at $183, and at 25, $172. Now, Wall Street themselves are yet to upgrade any of their price valuations. Before it was sitting at 222, which right now shows no upside into next year. Maybe we'll see that stay, maybe we'll see some upgrade, but for now, $222 is where they see this. And if you actually believe this is too conservative and want to see the MOS at 14%, which will naturally be higher as that indicates an intrinsic value of 263, we note 15%. Now give us your thoughts overall on where you see this company, and don't forget we did run through in a previous episode Barron and their estimation. Like the analyst we heard earlier, they see this at around $260, where in fact they said the search element, which was under question, was worth around $1.3 trillion. So it looks like a good day for investors of Google. The question is right now, is this a buy, hold, or avoid? Let us know your overall thoughts and whether you are happy with the decision. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.